I think the comedic phrase, beatings will continue until morale improves, actually kind of applies to what we're dealing with right now. Now, I mainly just wanted to use that in a video. I thought it would be entertaining. I do think it is entertaining, but it is kind of true. The NASDAQ, the S&P 500, but specifically tech stocks are getting absolutely hammered right now. I mean, we fell from 539-ish in mid-February down to where we are at 459. That is a really significant fall. It really is. So, what are we doing here? What do we think? What are we going to... Well, for me personally, if we take a look at some value stocks, specifically stocks like Cigna that I've covered on this channel that no one cares about, stocks like Vici, those sort of things are doing well. We're up 2%. It's almost inverse of the S&P 500. Certainly over the last 5-6 months, we're actually up 19% in the same time frame that stocks like the S&P 500 are down 10, 12, NASDAQ down more than that even. So there are stocks that are doing particularly well. So these value stocks that I hold, if we continue at the way that we are, if we continue to go down as dramatically as what we are seeing, if some stocks that I like that I hold are down 25, 30, 35, going on 40%, that's when I'm like, okay, that's a bit ridiculous. Like, I understand that 10, 12, 13, 14, 15% down, that happens. That's pretty standard. And you do expect tech stocks to get clobbered in a poor market. I have said this on this channel hundreds of times at this point. Tech stocks do better in the boom, and they do much worse in the fall, in the downfall in the bear market. We saw stocks like Meta, which are now, even after, coming back down to earth, are in the mid 500s. And it's just, I talk about it quite often, but the downfall of Meta is so dramatic, what we saw in that 22 bear market. It hit as low as, I think, the 80s. Literally the 80s. It's up here, 561. It peaked above 700. And it was doing pretty poor earnings-wise, but still, they fell from nearly 400 all the way down to 80. So there is time. You expect tech stocks to get clobbered in a bear market, in a poor market, whatever it may be. But that doesn't necessarily mean that it's entirely justified. And what I mean by this is there's a lot of tech stocks that are going to just hold up fine in the long run. They're going to be down in the short term, in the medium term, and then in the long term, they will be up. That's what happens. Now, I'm not saying some stocks won't get hit super hard and not make it through. You can see that specifically in unprofitable stocks. You may see a lot of companies go under. We saw that happen when a lot of companies IPO'd in 2021. Companies that rely on a lot of debt that are not profitable, maybe have very thin margins. Yeah, you can actually see companies go under in a very poor market, in a poor economy. That happens. But these Goliaths like the Metas of the world, the Googles of the world, stocks like that, Apple, Nvidia, even like a TSM, the odds that these companies actually are dramatically hurt long-term by just a market downturn is unlikely. And when we're seeing these stocks fall 20, 30, 40% from their all-time highs. I mean, TSM is nearly down 30%. I do think it was a bit higher than it should have been when we were hitting, 218-ish. I wasn't covering on this channel. I thought, somewhere under that one. I really, really like TSM. I talk about it all the time, but we have fallen, like I said, from 224-ish all the way down to about 160. That is a bit dramatic. It is. And now what I'm not saying is you need to go buy everything, sell all your value stocks and just buy them because it's not going any lower. I'm not saying that. But if we start to see things to continue to go lower, I'm talking another 5, 10, 12% off these stocks that have already fallen dramatically over the last month and a half. That's when it's starting to eye it. Once we start getting that 20p, even with things like the S&P 500. I covered it on a video a few days ago, and that video did fairly well, although I haven't really checked it in a bit, but it did do well. And basically the point I was saying is the S&P 500 cheap? And I didn't say it was cheap, but I said it was average. If we look at the S&P 500 historically, we got to zoom out even further here. Remember when the economy was so good in 2015, 2016, maybe some of you were not investing then, but if you don't know, basically from 16 to 18 to 19, and you can see here, we ran from 170 up to to 40. We didn't have any downturns in that like 3-4 year stretch. Well, we did have some, but it wasn't super dramatic. This was still well pre-COVID. During this time, the S&P 500 average was about 23.5-ish, somewhere in that, let's say 21 to 24.5-ish range. We are now in that range, right? 24.5. And of course, I've covered it. There's different ways to calculate the S&P 500's PE ratio. Some people will exclude stocks that aren't profitable. Some people will include them. Sometimes you take the latest possible earnings. Sometimes it's delayed a couple months. So there's always fluctuations in this specific PE ratio. But we are not crazy high anymore. We aren't in some crazy bubble. With this latest downturn, we are, like I said, we're in that a little bit on the higher end, but we're in that average of 2016 to 2018. And believe it or not, even after the downturn, if you bought in 2016, went into a coma, woke up today, you'd be like, hell yeah, I'm up 2.5%. Look, you're at 199, you're at 506. That doesn't even include dividends, which is right around 1%. So you're actually up even a bit more than that. So if you're holding a long term, if you aren't looking at retirement in 3 to 5 to 6 years, of course, not financial advice, but this is pretty standard. Buying the S&P 500 at these levels for the long term, you're no longer looking at crazy expensive. You're a little bit on the higher side of average, but you're not in some crazy bubble. It's going to implode. That doesn't mean it can't drop to 15 PE. I'm not saying that if we're in a terrible economy, but if you expect an average to slightly good economy, this isn't like you're buying the S&P 500 20, 30% higher than normally you would have to. We're looking at pretty standard. I mean, like people say the S&P 500 historically is somewhere in that high teens range, 17-ish. But people are like including the 1930s, the 1940s, the 1950s. Even like if you're talking 1980s, that is a long time ago, guys. Like a significant portion of people watching this video were not born then. And most of you were not adults in the 80s, or at least a large portion of the 80s. So I try to look at a little bit more recent than that, because even for single stocks, I don't look much past 2000. But if we're talking like 1930s and you're factoring into that to the S&P 500, we're in a completely different world. Most of your grandparents were not born not most, but a portion of your grandparents were not born in the 1930s. So why are we factoring that into the average of the S&P 500? I just think that's a bit ridiculous, personally. But so if we're talking the historical S&P 500 since 1991 sits somewhere in that, let's say, 18 to 22-ish range. And like you said, when we saw this boom, or we saw a good economy in 2016, 2018, we were in that 23-ish range, and you would have done phenomenal. So this is what I am thinking. For those of you who just buy into ETFs and hold, totally fine, that's good. I do that in my retirement account. I do a lot of single stock investing outside of that. So even if every single stock I own went to zero, which would not happen, but even if it did, I still retire a normal life. That's how I set things up. But even then, you should probably just be DCAing basically at any price point. But if we're just talking about the S&P 500 stocks in general, we're sitting at about an average range. We are. So just what I'm seeing here, DCAing into the S&P 500, although I would recommend that probably always, you certainly should not be worried about DCAing long-term into the S&P 500 at this range. The odds that you're down 7 to 10 years DCAing at these PE levels, you'd basically have to time a recession exactly in that 7 to 10, like I said, okay, in 8 years we're going to be up. You'd have to have a recession basically starting at that 8 years to be down. Like, seriously. It's very, very unlikely. It's possible you would see maybe a horrible economy in the United States. It's certainly possible, but historically it is incredibly unlikely. Incredibly unlikely. And obviously if we're talking longer than 10 plus years, it's even more of a safe bet. Now for single stocks in the short term to medium term, what I'm looking at, I'm still technically holding everything now. If we start seeing value stocks continue to run up, let's say another 5%, and we see tech stocks run down another 7 to 12%, we're seeing stocks like TSM down 35, 40% off of all-time highs, hitting 20 PE. I mean, hell, some of these value stocks are going to have higher PE than TSM. And we saw that. We saw that in 2022. We saw that, I think, briefly in 2023. If we start seeing that sort of thing, I'm going to start selling, well, of course, putting money in normally, more heavy into tech stocks, and then I'm going to start selling some of that value stocks and investing into those tech stocks. Why am I doing that? Well, personally for me, I'm not really near retirement. I'm not worried about that. I'm looking still at certainly 10 plus years, probably closer to 20 for me. So I'm not particularly worried about that. Of course, if you are 55, you need the money, you don't have an ample amount of retirement, you should hold your value stocks, probably. So, of course, not telling you what to do. We all do our own things. But for me personally, I want to buy into stocks that I feel are being unfairly punished, or maybe fairly punished, but in the long term are going to recenter themselves. Because that's just how these things work. So that's all I really got for you guys today. Meetings will continue until morale improves, and that is kind of true because until people stop panicking, hey, this isn't too bad, whatever, maybe whether that's in 1 year, whether that's in 7 days, whether that's in 3 years, meetings will continue until the morale improves. So anyways, thanks for watching. I'll catch you next time.